All right, folks, here we are on Trading Up. We've got Steve Ruffley back in the house once again for the third of our Q&As here. So, Steve, welcome back to the show.
Thank you, mate.
Today we're going to walk through questions around his strategy. We'll be definitely getting a price chart open and having a look at things. So, Steve, I don't know if you want to open it. You may as well just open the price chart to start off with so that we can crack into it. And I'll ask the questions. There are a number of different questions here. So let's go through the first ones. Hey folks, my sponsors City Traders Imperium have just launched some amazing changes to their funded trader program you got to check out. You can now skip the whole evaluation, trade gold as well as Forex, plus they've increased the drawdown you're allowed in both the evaluation and when funded. With C2A, it's even faster and easier to reach up to $4 million in funding with a 50 to 70% profit share. Click the link in the description to find out what else has changed. What are your rules for an overextended move, and in what time frame do you define an overextended move?
Yeah, I mean, an overextended move, I think this again comes back to my rules of Fibonacci. And, it's been able to identify a high and a low that hasn't been broken. So as long as you've got that high and low intact, 80% of the time, generally, you get a retracement to the 50%. Now, the longer the time frame move you take, then the longer that move's going to take to get back to that 50%. So it all really, again, revolves around what you're trading and when, because if you're trading a 5-minute candle, certainly that has worked well, and it used to work well, I guess, over data. So big things like GDPs, non-farm payrolls, etc. And you get those big moves, the market stops, and then have a retracement and a profit take on it. But I mean, for me, what I'm generally looking for is the hourlies. So I'm looking for candles like this. So when the market, again, closes mid-range, and then, we see the next candle open, and we see that, I guarantee, that must be near enough to 50%. So you draw your Fibonacci on that. So yeah, I mean, it's pretty much spot on to the 50%. So, I mean, you can see these things majority of the time. I don't necessarily have to draw them on because after 20 years and the number of, EAs and times I've looked at that, you've got, that's got a chance to get back to the 50%, but then you have to be buying, at the low of the candle here. And that can be, again, easier on your 15-minute charts. That's one of those examples where the market breaks down, the candle opens within the previous low and then gets back to the 50%. Okay. And it's not like, it gets back to the 50% within half an hour. So, that's what I'm saying. It's kind of like it doesn't break the low. So, you're still valid. You get a bounce off of 38.2 and it gets back to that. And that, if you look at the 5 minutes, maybe it gives you a better example. So, yeah, rejection, 1, 2, 3, 4. So it takes you 20 minutes to get back to that 50%. Now, that's a scalp still, because it's 20 minutes. It's relatively short periods of time. But what I'd be doing, again, when I'm in these kind of trades is I'm generally buying an overextended candle like this, expecting a wick. So I'd probably even be out before this candle opens, or might be a little bit braver and, be out in this candle. But I'd never be out at the 50%, ever. I'd never be out here at the 38.2. Because what I'm doing is I'm looking, and as I've said to you before on these different, kind of things, is I'm trying to preempt bounces and kind of movements within moves. So I'm saying, okay, yeah, the DAX can sell off and break these lows. That's great. But I know there's value all in these prices down here. So I'm trying to judge the best point in time and be lucky in some points. Again, you've got your daily level here. So I'd be kind of certainly hitting big size here, trying to get as much size as I can. Then as that next candle opens, as long as it doesn't open below, I know I've got a good chance of people taking profit and that market getting back to that 50%. Now, as I say, sometimes you've got to take a chance. A lot of people will be waiting for that candle to close and then getting involved somewhere in this candle. But then, you see the candle closes a bit of a doji. So if you're trading the kind of size I am, you've given money away, because, you would have been involved in the extremes if you kept going, taking that, a calculated risk that the next candle goes higher and towards that 50%. As you see, indecision, 1, 2, 3, 4, back to the 50%, then it goes down. And if you're, again, this is what I'm saying about leaving money on the table. If you do a 20-minute trade, then you hold it for another 30, 40 minutes, you're giving all your money away. And then, I've got it back, giving it away, got it back, giving it away, got it back. Oh no, I've lost it all. Yeah. It's like, this is the whole point of trading within a trend. You can buy, once you've got that Fibonacci in play, you can even look at the 23.6 to buy. You might not get lucky and hold it, to the 50% or towards the 50% again. That's what I said to you in these other interviews that we had, Cam. This is very important. You have an exit strategy. So I would never be waiting to hold, that for 20 minutes and getting out. I'll be getting out in this candle where it starts to really ramp up and like, because I want to take my money off the table before I start to give it back. And you see that the market gives it back and it actually goes lower. So actually, that could be like a 20 grand trade turned into a 5 grand trade or maybe, even nothing within minutes, within that 10 minute period. Why would you do that? Take the money when it's offered. When it goes low again, start to buy it up again. So this is the whole thing with strategy and my strategy. It's based upon movement, speed of movement, type of movement, and how we can put that movement into a framework that I understand. And that's picking that Fibonacci high and low. I mean, that's an overextended move, or you could even class it as an overextended move and an overextended candle, because this candle looks out the ordinary. Even when you look past, there's been, red candles, but nothing quite as big as that. But when you see a candle start to move and you don't know, you see, how that candle is going to look, because that's the future when you're looking at it. So when I look at how it starts to form, maybe on the 5 minutes or 15 minutes, it moves in a different way. So it moves very quickly, and what you see is it goes to the bottom of the candle and it never gets bought back up that much. It keeps pushing down and down and down and down. And that's when I know people are being squeezed out of positions, real size and papers coming into the market, real selling. But because of that overall view of people always dip buying and buying the dip back, it doesn't have to be the Fed anymore. It could just be your army of retail traders out there. I know I'm going to get a bounce. So yeah, of course, as I've always said, I could have made more money selling the break, etc., etc., etc. I don't do that. I put a framework around it. I look for that aggressive move, that speed and type of movement that attracts me. And that's through the levels, again, being able to put that Fibonacci framework around it, or just use my charts. Like say, well, listen, if the market gets below this daily, I know there has to be buyers around here in the short term. And yeah, the market might have done this and then continue to sell back down. But if you're trading at the extremes, you get a chance to make money or get out of a trade for a scratch, or at least not lose big money. Because again, if you're buying it here and hoping for that bounce, you get it, but you've got to wait a long time for it. And it doesn't actually really come in the long term. So again, it comes back to that time involved in the market, that aggression, being able to average and understand what you're trying to achieve. Okay, just because I write in my book that 8% of the time it retraces to the 50%, that's a technical framework, that's a strategy, that's a way of understanding. It doesn't mean that I'm always waiting for that. I want the money. I want to be right, take my money off the table. I'm not trying to be a hero and get every pip out of every move. That's just not how I work.
So you've pretty answered a lot of the questions here in that one answer, but we'll try and dive in a bit deeper on some of the things. So one of the questions is around trying to get information around how you actually work out when is the time to get in, i.e. are you looking at minute candles or the last few seconds of a minute candle, or like the close of a 5 minute candle, or how do you sort of define okay, now's the right time to scale into that trade? And are you sort of just going, it's price or what? I mean, what is the sort of defining factor of I'm going to click the buy button?
Okay, well, if I've decided to do a trade, I'm focusing on one market, I'll generally look at this screen. So this is the German 30, the DAX broke down into daily, hourly, 15-minute, and 5-minute. So what I'm looking at is how we're performing with the hourly and the 15-minute around the fibs. So we can see, have this consolidation period around here, close below the 50%, and it's just bang, it's down all the way through to the 426.3. That's a great indication that that market wants to sell. Even better on the 15-minute. Sell, 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 sell. Doesn't hit the 423.6. So that's kind of like, all right, okay. So maybe we've got a little room further to go on the downside. Then the 5-minute, the chart does exactly the same thing. Again, 5-minute, 1, 2, 3, 4, all the way down to the 423.6. And again, people will be out there. If you want these charts, you can just sell here and hold on. You can make your money however you want to. That's absolutely fine. You can have the charts, you can use the fibs, and you can trade the way you want. But what I say is that, yes, that's what I'm looking for. I'm looking for that overextended candle on the way down. I'm looking for the market to being pushed, getting all those weak longs out that have tried to pick the bottoms here and have the stops in weak places. And then as it comes down, rejects that daily level, and I'm loading in as much as I can at this point, knowing that it's very unlikely that red candle is going to close fully red, and the next candle is going to be red also, and it turns to green. So again, which shows in your pull back. And it's tiny little pullbacks on the 15-minute and the hourly, nothing on the daily. But that's enough money right there, if you're aggressive enough, to have a really good win, a really good trade. And for me, it's better odds looking at the overall trend of the markets where we've seen, a gap, close, gap back up, fill. Yeah, it still looks like it could be a little bit dicey, towards the sell side. And I would never position myself and buy, the DAX here and walk away and then, expect it to be up here. But as a short-term trader looking for those 5, 10-minute trades, this is where your money is, right there. That's where your money is all day long. So again, it's by looking at the different time frames and understanding for the time I want to be involved in a trade that maybe after 4 red candles, there's a chance of a green candle and I'm out.
And so you would, so I suppose in answering the question, you basically wouldn't be looking to wait for a close of a candle or a minute candle. You're literally going, this is where the price is. Yeah. I'm going to enter in candle whilst it's growing and thinking that this, these are the external factors that are potentially going to help me anticipate where price is going to go. Great.
I mean, you have to remember, I do a lot of these things, in real time. So I've already considered the correlations. I've already considered my fundamental views, my technical views. And I'm not trying to make myself sound cleverer than I am. I'm a smart guy and I've studied this stuff for a long time. But a lot of the things I've got are inbuilt. And that's why I'm not trying to overcomplicate my strategy or thinking, I think it's coronavirus Omicron that's sending the markets down. The market's going down because it's going down. Okay, but I know that there were people that'll be wrong, that people want to get their big size out for some quick profits, in the small, medium, and long term. And I know that I can trade the DAX with a bounce. So I'm looking for these kind of hourly correlations, 50-minute correlations, and I can see, again, there's every chance this market can go lower. But for where I would be looking at that point, I'd be, again, looking for the overextended candle and buying a 50% retracement, which I guarantee that's got to. So it's not a 50% retracement of this move. It's a 50% retracement of that final candle. 80% of the time, it works. Doesn't make a new low. Okay, it doesn't necessarily mean it's going to, make a new high, but it's got to the 50%. And how many pips is that? That's 13 pips or so. It's enough. It's enough to make some money. Again, when you're averaged in aggressively trying to predict the future. So if it got to this level, great. If it broke it, I'd be buying even more. But I'd just be buying lower down the range. It'd still have the same kind of movement, probably getting back to the 423.6. But this is the whole point. It's not about being right. It's trying to predict the future, and it's trying to predict, the future of that candle or the future of, that small move based upon the bigger, happenings of what's happened. Because if you get dragged back into the daily view or even the hourly view, you're thinking, well, it could touch the lower Bollinger Band or get back to the moving average or back to the 50%. You're starting to justify what could happen. And that for me is just alarm bells. If I see something happen, I want to be in as it's happening and out before it's formed. So I'm never looking for a candle to close necessarily. I'm looking to get out. And that's what I'm saying is when I see my trade on side, I'm focused on the P&L moving, and I make a decision based upon that, not necessarily where the candles are going to be. Because for every time you think, okay, I'll watch a 5-minute candle close, and every time you watch it, it's like, it doesn't do it. So it's like, oh yeah, if I just watch that candle close, it'd be up here. But it's just like, yeah, I tried that. And after 20 years, it's like, yes, it worked some of the times, but I ended up kind of waiting here, then it was down here, then it was up here, then it was down here. And I've took my focus away. I broke my rules. I've stopped taking money off the table. I've stopped banking profit. And I've started to try and predict what the market's doing. And even worse, trying to justify to myself why it's doing what it's doing. When I could have just took the money and been out of the trade and be off and be finished. I made my money for the day and be gone. That's the difference. It's the money versus time.
It's essentially, so the next question was going to be like, what's your take profit target? But I think the answer is you've just given it. There is no take profit target. It is very much a get the money off of when it's available. Is that right?
Yeah, I mean, it's an amount of money. And as I say, the market will offer you an amount of money for the first time. And it's generally as high as it goes before it comes down significantly. Not saying it won't go back there, but it might take a longer time to get there. And invariably might make you more money. But then you're turning a scalp into a different type of trade. I generally kind of, work on kind of round numbers. I know, how much I've got in the account. I know how size I've put. And, generally, that's a $5,000 trade. That's a $10,000 trade. If I'm a little bit more aggressive, maybe that's a $20,000 trade. And it's just kind of like, that's it. It's not like you don't want to be a prick for a tick. You don't want to get out an exact round number because that makes you feel special. Okay. You can be waiting for that number to go 2000. And it's as you press the button, as again with the close all and the waiting for the markets, it might get down and settle you. And you've done $16,000, $15,000. You might have lost $5,000 trying to hold on for that round number. Money's money. I want to be getting out before the market takes it away from me. So yes, I might leave the opposite of leaving money on the table. I might leave plenty of potential profit on the table. But I'll tell you what, you never go skint trading banking money. And that's just one thing I've learned. And that's why I have the rules and the strategy in place. I can also be flexible. But my number one rule is take the money when it's offered, generally the first time, because it only gets harder after that.
So this question, I don't even know if you're going to know the answer to it, but we're going to ask it anyway. On average, when you sort of gain or lose, what's the number of pips or points that you would lose or win?
I mean, it's a difficult one. Cause, I'm not like a MyFX book, kind of trawling through each trade and, what was my Sharp ratio on that? I'm just not that kind of person. That doesn't interest me. I mean, it might be an interesting tool for other people to use, but the beginners. What I'm looking to do is always use my size, and I know, when I've done X amount of clicks, I know instantly X amount of how much rough size, because you might not know exactly that every trade was filled, but then you got a rough idea of again how the market's moving when you see your P&L going on side. It's just the same, people with smaller accounts will see the trade, go 10, 20 on side, 30, 100. And it's just different. For me, it's like, 2, 3, 4, 7, 10 grand. And it's like, yes, I know for experience, that short period of time, 10 grand's good because that's a certain percentage of my account, and a certain amount of percentage of that trade that I'm happy taking. Because again, I'm never looking to hold a trade in its entirety. I'm looking to take that money off the table and maybe go in and do the same trade again several times. It just depends how I'm feeling. I'm there when I'm trading in front of the screens to make money as quickly as I can, turn the screens off and then go away, because that's what I do. I'm not sat there all day. I'm not watching the charts all the time. If I miss something, I don't care. When I'm trading, I want to be trading as aggressively, as much size as I can, getting in, getting out, and then turning the screens off and going and doing something else, because that's what I value more over money is my time. And you can easily get dragged into the markets. And I know people get a buzz out of it and people, I was up for 10 hours trading. I love it. Yeah, you might have made 5 grand and then you might have lost 4 grand and then made that back on the last trade. Whereas I've took my money, I've got out the trade in 15 minutes and then the world's done whatever it's done. I don't have to chase the money anymore. I do okay. What's more important for me is getting those trades right, getting the money off and letting the world and other traders worry about what could be, because who cares what could be? I have my targets. I generally hit them or I get stopped out. And then, it's just another day. It's another day of trading. I don't get excited when I make money. I don't get upset when I lose money. It's just part of trading.
Now, do you have any hard and fast rules that you use or sort of stand by to get into these, scale into these positions?
I mean, it has to be, again, in the position and the direction that you want. So, just because the markets move really quickly, you can't just jump in if you don't have some idea. And, it's always good to have, a squawk service or to have some, Twitter feeds open, or the markets can be moving in a particular direction because of the fundamentals. Something might have changed that's changed people's views. You have to be aware of that. You can't just fade moves all the time because, some fundamental moves are moving for a reason. Like an unexpected rate hike or terror attack or something else could happen. And if you're on the wrong side of it, you'll just get wiped out. So you have to understand why that market's moving or have a rough idea. I don't just get dragged into movement because it's moving. And again, I'm very regimented that I'll only buy and sell certain products, which kind of takes away half of the kind of desire to trade or half the opportunities. And that's fine, because the less opportunities you have, the more confident you are in your view, marrying it up with the correlations and your strategy, and then be able to make some money from it, consistently getting that momentum and carrying on. If you're just trying to do a trade that, you're just blagging or made up or just saw something move so you did it, how do you replicate that? You can't. Trading success comes to be able to replicate something time and time again. So my kind of hard and fast rules are, am I buying the DAX at value? Is it trading with correlations with gold and the other markets? Is it doing something I understand? Can I make some money from it? And that's my rules, because I will take probably less trades than I used to. Again, I used to be like most traders. I can have a little 10, 20 lot punt on that. That could be all right. Can make some money there. I don't do that. There is no what ifs. If I'm not pressing that button and getting all my size in, than it is in the trading opportunity. So that's what stops me from being, a trader that, just kind of, punts and makes mistakes. It's like, if I make a mistake and I'm doing it for no reason, you're going to get wiped out. You're going to get killed. So, if you go in with the mindset that, this is the trade, I'm putting all the size I can in and being aggressive, then you have to, all the kind of correlations and signals and all the experience you have has to sing out, because if it isn't, why are you doing the trade in the first place? Don't do it at all.
Okay, guys, last question of this this session. So do you ever hedge a position? And if so, what's the process?
There's no hedging in trading. Obviously there is for long-term views, like, hedging the dollar against different currencies. If you're just kind of, looking to hedge, your position, you're just going to kill yourself both ways. And I've seen millions of traders that do it. They aren't experienced in trading. They're wildly offside, so they hedge it. Then they make some money in the hedge. They don't take it off early enough, and they end up losing on both. And you mean like hedging across products, like, buying, the stocks and selling gold. You're basically just doubling up on your risk. Hedging for me is for a certain type of trader, certainly for a longer term trader, and for people that hold a collection of different things that might experience short-term moves. So if you're a day trader, hedging is just the quick fire, absolute quickest way to destroy yourself on both ends. So no, I don't do it for short-term trading at all. And I don't recommend that anyone does under any circumstances in any way. It just isn't for daytime trading.
Hey guys, ever wonder what broker I use? Well, I use these guys, Hanko Trade. Look, it was a no-brainer for me because I was looking for a broker with really good trading conditions and one without any leverage restrictions. Look, also, by joining Hanko Trade, I was able to cut my cost of trading significantly with their super low commission of $1 per 100K. Look, if you want to find out more, check out hankotrade.com, or there is a link in the description. Cool. Awesome. Well, look, guys, that's some fantastic insight into Steve's trading strategy there. We've got more stuff coming out for you, routine and psychology, so stay tuned for those videos. But before we wrap up on this one, Steve, what's the best way for the guys to get hold of you?
Well, as always, just Google me, Steve Ruffley. There's plenty of stuff. My YouTube channel, lots of views. Twitter is where I kind of hang out, so just at Steve Ruffley. Or the good old email, steve@steveruffley.com. You can just talk to me directly. And I'm happy to speak to anybody who's interested in learning some more about how I view the markets, I guess.
Brilliant. Well, look, guys, we did shoot an interview a while ago, and we've got all these other Q&A series as well to go through. So if you do want to find those, they're going to be in the link underneath this video here. Also, do remember, hit subscribe, hit like, and click on the notifications bell, and click all if you do want to see videos like this in the future.